New report on AI risks has led to a material breakdown in financials. Even before Nvidia's earnings, things are already starting to crack. So let's take a dive in looking at that now. Hello, everyone. It's Patrick here. Thanks for joining me for this live macro outlook where we break down the markets as we see them. Moving forward, I'm going to be here every day live, Monday through Thursday at 9:30 a.m. Eastern. So if you're loving this, plug me into your morning routine. So let's dive in and see what's going on. All right, so I have here an hourly chart on the financials, and what you can see here is the a material breakdown in the banks, particularly in yesterday, which broke to lower lows. When we put this on it's about a 10% drop since the start of the year, and but it's a breakdown to 6 month lows, right? So like we had this big established trade range going all the way back to July, and the financials are breaking down. Why? What happened here? And what is it that you need to know? Well, this breakdown happened because the markets are reacting to a new report from Citrini research that was titled the 2028 Global Intelligence Crisis. Now, it went on making the whole story of what things will look like moving forward, that AI is not just a productivity story, it's a speed story. And one of the things they were highlighting was that if white collar workers get automated faster, then incomes adapt, consumer confidence will weaken, and then and when confidence weakens, spending slows. Since consumer spending drives the economy, the pressure shows up in the credit markets first, and that's the risk to the financials. Loans are written on stable incomes. Payments networks are dependent on transaction volume. Private credit depends on reoccurring cash flows. And if the entire income layer gets questioned, the entire financial system feels it. So when this report came out, just going back to the chart, the financials broke down, but it wasn't just that it was a breakdown. One would say, "Oh, well, look, the November lows, it didn't really do anything crazy." Well, sure, because like a J.P. Morgan, which is still up along its highs, but what's important is to look at what's happening on the different credit card names. Like for instance, let's just start off with Visa and Mastercard, but Visa is back down to Liberation Day lows. You have MasterCard trading down almost at Liberation Day lows. Capital One, um, there we go. So Capital One, a fresh, clean breakdown to lower lows. AXP breaking down, and as American Express gets going. Not only that, look at the way that private equity firms are looking. The most guilty culprit is Blackstone, which is actually broken below its Liberation Day lows. It's been in a vicious bloodbath in the last 4 or 5 months, down 41% off of its highs. These financials are starting to crack, and it's starting to send that concerns through the market. This is really important. I've said it before when I did the previous banks YouTube episode, was the fact that they are the quintessential beta 1 asset. The S&P 500 correlated to the financials is like a staple truth. Like in the end, S&P 500 can't really, or has historically never really had any meaningful rally without the financials being a full participant in those moves. Here are the financials breaking down. Now, what we have seen is the great sector rotation getting underway. Still, consumer staples, healthcare, energy stocks, all at their highs, getting a huge rotation as there's aggressive selling in these Mag 7s and now the financials. Now, the question is what does this mean for the market, and when will this change, or will it change? Well, we talked about the importance of Nvidia. We'll even talk more about it tomorrow, and particularly Thursday once we see the reactions. But I want to focus today more on the market breadth. And the breadth of the market is just how many stocks are actually trending and participating, we've actually had a very healthy breath because the sector rotation has been out of a small number of mega cap names in the Mag 7s and been sprinkled out into a whole bunch of the other components in the market, which has basically allowed the breadth of the market to actually stay somewhat healthy while just that concentrated selling has been in there. This is probably one of the more important things to watch, because if this starts breaking down, it means that this is no longer a Mag 7 rotation, but this is potentially widening to a broader market sell off. I still think Nvidia is going to decide whether this becomes a bigger thing, but you can see we're deteriorating in the market breadth. We're down to 60%. The real flag for me is when we're below 50%. So we still have a cushion. I don't want to write off the bulls on this one there. But the other thing we've been talking about is that S&P 500 equal weight index. Just as a reminder to people what this is that rather than allowing those Apples and Nvidias to be such huge components of the S&P 500, this S&P 500 index takes all 500 companies and gives them the same market cap weighting equally in this distribution. And so what we're looking at here is that the actual S&P 500 on an equal weighted basis has actually been in a beautiful uptrend. It's been working. That's the sector rotation story working. Well, what we're going to watch now is that will this in any way crack? Because really at this moment, so long as it's a sector rotation story, in theory, the stock market can hold up, and you don't need to over boogeyman things. But really at this moment, we have this trend line in the 50-day moving average just sitting around 8,000 that is going to decide whether or not this trend actually can continue. And so we're going to watch this equal weight index very, very closely. What we're seeing already is things like, for instance, the Russell 2000 has been heavy since the start of the year. It made its high up around January 21st on a beautiful bull impulse on the upside, which was this little measured move, and since then has been consolidating in a horizontal triangle. This could theoretically resolve itself bullishly. I don't want it. It's been holding above its 50-day moving average this entire time, but it's on a knife's edge here. And we're going to find out whether the small caps can hold things together right at this moment. Again, we're really at an inflection point on the markets. I think that if the things were going to unravel, it's not going to take too long for this to happen. In the end, software stocks still breaking down. Mag 7 still awfully weak. The story's still there, but the financials, that's a problem. Now, one of the things we highlighted before, and I'm going to bring it back to that, what we have here is the breakdown in the senior loans ETF. Now, this is a variable rate of loans and much shorter in duration than junk. And what you can observe is that the credit conditions are substantially deteriorating, and it's not being shown in the junk bonds, but it is being shown in private equity, and it is being shown in senior loans. And so what is it that the senior loans are telling us? That credit conditions are tight. And certainly that is showing up in the financials, which we're talking about today. So, well, what is it that we need to know? Well, first of all, at this stage, do you want exposure into the banks? Well, look, many of you have legacy bank positions, and I don't necessarily think that this is like has to be a great financial crisis like we had in 2008, but when it's conditions like this is the right time to hedge things up. I don't want to necessarily encourage people to short sell these financials, but this is a very healthy time to overlay some protective hedges, and that's certainly something that I'm looking at doing quite actively in this type of a market environment. Is that you want to make sure that you're protected on these things, because this is clearly not a healthy part of what's going on in this market. So anyway, this is where we're going to wrap things up. Watch these financials. Watch what is happening here. Let's see whether or not this keeps actually getting worse. Obviously, I keep focusing on like the Nvidia thing is going to be a big deal. Well, let's see. I think it's going to be a big deal in this manner because the Bulls need something. The Bulls need something that just turns the sentiment and gives everyone a little bit of breathing room. And if Nvidia was to beat on its earnings and gap higher, it will allow the Bulls to just take a sigh, like a breath, and allow them to regain their footing, and maybe the market can stay stable. But at the same time, this market is so fragile and so weak right now that if we have a bad miss from Nvidia, it could really get things going. So, all right, this is where I'm going to wrap up the public part of this live stream. From here, I'm jumping over live to Big Picture Trading with my members. We're going to be looking at a number of breakout trades. We've got a brand new breakout trade we just published this morning. We're going to be putting it on live in the session, and we're going to be talking about a whole bunch of stocks. This is the Tuesday episode where we dive into all sorts of individual stock charts instead of staying macro. So it's a great session. So if you want to join us and see how we turn all these ideas into trades, you're invited for a 14-day free trial of Big Picture Trading. Just click on the link in the chat and or just go to bigpicturetrading.com and click on the 14-day free trial. Once you're in, you're able to see in the private members area the trade on the right hand side with a big orange button that says join now. We'll be live streaming with members in that webinar. If you're on the public side, well, thank you for joining me. I'm going to give you an update tomorrow, and of course on Thursday when we see what the aftermath of those Nvidia's earnings are, and we'll see those starting the free trial. We'll see you on in a few minutes. Thanks, everybody.